Welcome to Countats. In this lesson, we're going to be looking at the analysis of transactions. We're continuing with the grade 10, paper 1, November 2023. We've done a lesson on this same paper looking at the statement of comprehensive income or the income statement. So you'll find the link to that lesson in the description below. But here we're looking at the analysis of transactions. But this is really the accounting equation, understanding the accounting equation. And it will greatly help you, in fact, in understanding all the other journals and ledgers and the trial balance and even the statement of financial position particularly. Okay, so let's see how we go about doing this. It's a very easy and simple exercise, although they've allocated a lot of marks for it. So let's go through it one by one. Now, you're asked to analyze the following transactions according to the headings provided in the answer book. The business uses a markup of 50% on cost. Assume that the bank balance is favorable for all the transactions. Example, bought stationery for 2,000 Rand cash. And so here's what they have in the answer book. Okay, so we just copied what is in the answer book and put it here in Excel so that you can see what was already provided, and then we will be able to answer the rest of the questions, or from 1.2.1 to 1.2.5. Okay, so they gave you an example here. Bought stationery for cash 2,000 Rand, and they said account debited, that is stationery, account credited bank, the amount is 2,000 Rand as we're given. And then it's a negative to the asset. Okay, so it's A or L, assets, owners, equity, and liability. So it's a negative to the asset, negative to the owners, equity, and 0 for liability. So when they put 0 there, they're saying that it's not relevant or it's not applicable for this particular transaction where you bought stationery for cash. Okay, so here's what I want to mention. If you are going to do this question well, and if you're going to understand it well, if you're going to answer it quite easily, you need to know what accounts you're dealing with. Okay, what account is an asset, what account is owner's equity, what account is liabilities. You need to know what forms part of those accounts, because that will determine whether you're debiting it and crediting it. Furthermore, you need to know what account is debited when and what account is credited. Okay, and for that, we have done a lesson that is called Accounting for Beginners Part 1, where we gave an acronym, and I'm going to give it here and show you how easy it is to remember what you should debit and what you should credit, and also know what forms part of assets, what forms part of owner's equity and liabilities. If you know that, this question should be very easy to do and you'll move through it quite quickly. Okay, so let me show you the acronym that we gave in that Accounting for Beginners lesson 1, and I would encourage you to watch that lesson. We've put the link in the description below. So here's what we said. The acronym we use here, and it's quite an easy one. It's DEAD, D-E-A-D, and then CLIC, C-L-I-C. Okay, so what do these stand for? So I'm just going to put the D and the C in bold. Okay, what do they stand for? Well, the D stands for debit. And what does the E stand for? Expenses. And so I know whenever I have expenses, I have to debit it. Whenever I incur an expense, I have to debit it. And then we also debit assets, and then we also debit drawings. Okay, so this is the acronym that we gave. And on the right side, we've got CLIC. Okay, what does the C stand for? It stands for credit. And what does the L stand for? Liability. So whenever I have a liability, I know that I have to credit it. And then the I stands for income, and then the C stands for capital. Okay, whenever the owner invests money into the business, that is capital, and so I know I have to credit it. Now look at the example that they gave us here. Bought stationery for 2,000 Rand cash. Okay, so I need to ask myself, what are the two transactions? I can already tell you now, whenever you hear the word cash, okay, whether you're paying cash or you're receiving cash, you know one of the accounts is bank there. And you ask yourself, in this acronym here, what is bank? Bank is an asset. Okay, so bank is an asset, so I know I have to debit bank if money is coming in. Okay, but if money is going out, actually I will do the opposite. I put it on the credit side. So you're seeing here, this acronym DEAD is when that particular account is increasing, but when it's decreasing, you put it on the opposite side. And so for instance here, you bought stationery for cash 2,000 Rand. Okay, so I know if it's bought for cash, bank is affected. And I know that bank is an asset. We usually debit it if money is coming into the bank account. But if it's going out of the bank account, I put it on the opposite side. I put it on the credit side. And you can see that's exactly what they did in the example here. What about stationery? What is stationery? Well, stationery is an expense. And where do expenses fall in the accounting equation? Well, expenses go under owner's equity as a negative. Okay, so I know that stationery is an expense, and I go to my acronym here, DEAD, and I can see I have to debit my expenses because my expense is increasing. Actually, I've incurred an expense. So that is why you're seeing stationery being debited here. when you're buying stationery for cash. Okay, I hope that has made sense. And you can see under assets they put it as a negative. Why is it a negative? Because money left your account. Bank is an asset and money left your account, so you have to put it as a negative. So whenever you have bank, when you're doing your accounting equation and you are doing the analysis of transactions and you're given something like this, you know that whenever you have bank and you have paid for something, you're gonna put bank as an asset and it's going to be negative. You put it as a negative because it's reducing your assets because money just left your account. And then whatever expenses you have, if you're paying for an expense, you put it as a negative under owner's equity because expenses reduce the owner's equity. I hope that has made sense. To understand more, of course, we've gone through that lesson, as I mentioned, Accounting for Beginners, lesson 1 or part 1. We go through it in great detail in understanding this theory. Now, what you want to do is that if you are new to this or you're hearing this acronym for the first time, just write it on top of your paper. Write it on top of your question paper or on your paper where you write your notes, and then you will be referring to it, because this is not the only place, by the way, you'll refer to it. There are other questions where you might have to refer to it. Okay, so let's move right along. 1.2.1 bought equipment on credit for 10,000 Rand from Shwane Furnishers. Okay, so we bought equipment on credit. What is equipment? If you watched our lesson for Accounting for Beginners part 1 or lesson 1, we already said equipment is an asset. Okay, and that's what you need to know now. Equipment is an asset. If I bought equipment, equipment is coming in, it's increasing. I go to my acronym here, debt. You can see assets is debited. Okay, so equipment is an asset, it's debited, so that's why you can see here they've already given us account debited is equipment because equipment is coming in. So whenever you buy an asset, you know that you have to put it on the debit side. Okay, so we put equipment on the debit side, and then what do we credit? Well, if you bought it on cash, as I mentioned in the first example, we would have credited bank, but we didn't buy it on cash, we bought it on credit. What does that mean? It means that we still owe the 10,000 Rand because we bought it on credit, meaning we're going to pay later. So if we owe money to someone else, what do we call that? Liabilities. Okay, so we're going to credit liabilities. So we know the first account is equipment, and equipment is an asset, and the second account is liability. But what do we call that account? We call it creditors control. Okay, because we owe our creditors. Okay, so I'm going to put here account credited, creditors control. Now, creditors control is a liability. Okay, so whenever your liabilities increase, you put it on the credit side. That's why it's account credited, creditors control. And you can see here in our acronym, liabilities is credited. Okay, so whenever I buy anything on credit or I take out a loan, I know liabilities is involved there and I have to credit the liability. Okay, and what is our amount here? Our amount is 10,000 Rand. So I'm just going to put here the 10,000 Rand. And then is asset increasing or decreasing? Well, it's increasing because I just bought an asset. So I'm going to put that as a positive, okay, because my asset has just gone up. And then owner's equity, that is not applicable because this transaction has nothing relating to owner's equity. And then liabilities, of course, our liability is increasing, meaning I'm owing my creditors more money because I just took equipment on credit. So I'm going to put that as a plus as well. And by the way, what you want to do is that you want to be checking with each transaction, is my asset still equaling equity plus liabilities? Because you know the accounting equation states my assets must equal my owner's equity plus my liabilities. So you can see that for the first one here, the example they gave us, it's minus 2,000 under assets and minus 2,000 under owner's equity. Does it still equal each other? Yes, because my owner's equity is minus 2,000. There's nothing on liabilities and my assets is minus 2,000. So assets still equal equity plus liabilities. For the second one, we've got equipment plus 10,000 Rand under assets. And then if I add together owner's equity and liabilities, owner's equity is 0 and my liabilities is plus 10,000 Rand. So it still balances. So you want to be doing that check, okay, to say with every transaction that I put the answer, does my asset still equal my owner's equity plus liabilities? If the answer is no, then you know you've done something wrong somewhere. Let me give you an example. If you put plus under assets for equipment, and then you put minus under liabilities for creditors control, so you can see you have a positive under assets and a negative under liabilities. So my equation doesn't make sense. My asset is plus 10,000 Rand, my owner's equity is 0, my liabilities is minus 10,000 Rand. So it's plus 10,000 under assets and minus 10,000 Rand under owner's equity and liabilities. So you can see they're not matching. They have to be the same amount. If I add together my owner's equity and liabilities and compare that to what my asset is sitting at, they have to be the same amount, okay? And we've done a lesson specifically on the accounting equation, and we'll go into great detail on that as well. If you still are not making sense of it, you'll find it in the link in the description as well, in addition to the Accounting for Beginners lesson 1 that I've just mentioned. Okay, so we've just done the first one. Let's do the second one. A debtor. Who is a debtor? A debtor is someone who owes us money. okay, who owes the business money, paid 4,750 rand via EFT in settlement of her account of 5,000 rand. Okay, so we received money from a debtor, and if you know what the debtor is and it says that the debtor paid, you already know I received money. And what did I say when you receive money? Bank is involved. And when we receive money, we know that bank is involved, and we know that bank is an asset. And you can see here in our acronym, assets is debited, okay, when it's increasing, and our bank is increasing here because we're receiving money. So I already know 1.2.2, I'm going to put there bank, and then of course they already gave us the credit will be debtor's control, okay, because when my debtor pays me, my debtor's control is going down. What does that mean? It means, remember, in my books, I have the amount that I'm owed by my debtors. But whenever they pay me, I have to remove that specific amount that I was paid. That means I'm reducing my debtors control. What is debtors control? Debtors control is an asset, okay? And if my asset is decreasing, our debtors control being the case here, then we put it on the credit side. So don't be confused. We've got bank, which is an asset. It's going up because money is coming in. 4,750 rand, and then we've got on the credit side another asset that is going down. Debtors control is going down. So here's what I'm going to say. Whenever your debtor pays you money, you will always debit your bank because money is coming in, and you will always credit your debtors control because you're reducing the amount of money that you are owed by your debtors. But what is our amount here? You can see here that we received 4,750 rand, and it says in settlement of her account of 5,000 rand. So this person owed us 5,000 rand, but they're only paying us 4,750, and that has settled their account. What is happening to the other 250 rand? That is 5,000 minus 4,750 is 250 rand. Why are they not paying us the full 5,000 rand? Well, the easy answer there is that we gave them a discount. Whenever your debtor is paying you and they're paying you less than they should, and they told you that they actually settled their account, you know that you gave them a discount. Okay, so what is the amount here under the first part of the transaction? Well, we know we received 4,750, and it's going to be under assets. We've got a positive, okay, and then in the same block or in the same square, I'm going to put a negative as well. So you would put it under the positive, so you'll put the positive on top and a negative just under that, but in the same block. Okay, why am I doing that? Because I know bank is increasing, my debtors control is decreasing. They are both assets, so it's a plus and a minus under assets. And of course under owner's equity it's nothing, and under liabilities it's also nothing. Okay, I hope that has made sense, and you can see my accounting equation still makes sense. I've got a positive under assets and a negative under assets for 4,750, and so they both cancel each other out, and I've got 0 under owner's equity and 0 under liabilities. So I've got 0 under assets, and I compare that to the total of my owner's equity and liabilities, which is also 0 and 0. It matches. Okay, so my assets still equals my owner's equity plus liabilities. Now we are not done with 1.2.2. We have to account for the discount that we issued to our debtor, and so what are we going to call that? We've got discount allowed. Okay, the first thing, let me just show you here. Our credit is going to be debtor's control, okay, and the amount is 250 rand. Okay, why? We're reducing the amount that we are owed by this debtor by a further 250 rand because we gave them a discount, so they no longer owe us, so we have to remove it from debtor's control. Okay, but what is our debit? Our debit is discount allowed. When you give a discount to your clients, that is an expense. And what did we say? Expenses are debited here because expenses are going up. Okay, so I'm going to put here discount allowed. All right, and what is the effect here? We know discount allowed is an expense, so that is owner's equity, and expenses under owner's equity is a negative. Okay, so I'm going to put a negative there, and then my debtors control is an asset, and we know it's going to be a negative as well because our debtors control is going down. They no longer owe us the 250 rand, and of course liabilities is not applicable here. Now here's something I want to tell you. If you look at the solution for this paper here, they actually got it wrong. Where did they get it wrong? You see here under owner's equity, they actually put it as a positive, which is wrong because discount allowed is an expense. It's supposed to be a negative. Okay, and it won't make sense. In fact, if you take our assets, which is a negative 250, and then you take owner's equity and liabilities, and under owner's equity it's a positive, it doesn't match. Okay, my asset doesn't equal my equity plus liabilities, because I would have a negative 250 under assets, and then under owner's equity and liabilities I have a plus 250, which doesn't match. It doesn't equal each other. So I can tell you for a fact that they made a mistake by putting owner's equity as a positive. It's supposed to be a negative. Feel free to check with your teacher or whoever you know that knows the subject, and they will also tell you that they definitely made a mistake there. So that's something to point out, because unfortunately some people will use this to study for their exam and do it exactly the way they've done it here. If you receive a similar question and think that it's correct, but it's actually incorrect in that respect. So just take note of that. I hope it's making sense so far and it's becoming easier as we go along. 1.2.3, sold goods for cash. Let me stop right there. If you sold goods for cash, you know it's bank. And they already actually gave us here, they put bank as the account debited, which is correct. So you know you already have a plus under assets, because bank is an asset and money came in because you sold goods for cash. The cost price was 3,000 Rand. Now, if you're selling goods, and this is what is called the perpetual inventory system. If you have not done it before, let me not complicate things here. I'm sure you'll deal with it next year or in the year to come. But basically here, when you sell goods, you have two transactions that you have to do, okay, that you have to account for. You've got sales and you've got the cost of sales. The first one is to record the money that came in with debit bank. And what do we credit? We credit what is called sales, okay? We credit sales. And what is the amount there? Well, we have to figure it out, because we are told the cost price was 3,000 Rand. That means we bought these goods for 3,000 Rand, but we didn't sell it for 3,000 Rand. Because if we sold it for 3,000 Rand, that means why are we in business? We're not making a profit, we're not making a loss. So we need to sell it at the markup or at the profit, okay? So what is our profit or what is our markup? How much do we add to our cost price to be able to make a profit? Well, we're told here on top, the business uses a markup of 50% on cost. That means this 3,000 Rand, I need to add 50% on top of that, and that will be my selling price, okay? And by the way, why did I put the account credited as sales here? Well, that's because sales is an income, okay? Sales is always an income. And if you look at my acronym here, we've got credit, income. So we are crediting our income. So whenever you sell to your customers, you will record sales and you put it on the credit side, because sales is an income. And I can already tell you that say income is under owner's equity. And income is a good thing, so it's increasing our owner's equity. So it's going to be plus under owner's equity, okay? But as I was saying here, we need to add the 50% to the 3,000 Rand. So let's do that. I'm going to take my 3,000 Rand times 150%, because that's what I want, okay? 150% divided by my cost price is equal to 100%. Now let me quickly explain that. When you're told that you're using a markup, your cost price will always be 100% and your selling price will always be the 100% plus the markup percentage. In this case, it's the 100% plus the 50% gives you 150%. So whenever I want my sales, okay, whenever I want my sales and I'm given my cost price, I will take my cost price times 150 divided by my 100. What's the logic behind that? Well, my numerator here being the 150 is what I want. My denominator here is what I have, okay? If you want to understand more on that, we have a link specifically on markups and margins and how to do the calculations. You'll find it in the link in the description below. But basically, if you're given cost of sales and you want to calculate your selling price, is the amount that you're given, which is 3,000 in our case here, times the 100% plus the markup percentage, which is the 100 plus 50, gives you 150, and then we divide that by the 100%, okay? Or the 100. And you can see here it will give me my answer, 4,550 Rand. Okay, remember that's when you're recording the sale itself, because you're selling your goods at a higher price than your cost price. That's why you're given the markup here. Okay, so bank is an asset, it's increasing, okay, because money is coming in. So I'm gonna put plus under the A or the assets, and then owner's equity, as I mentioned, sales is an income, it goes under owner's equity. Sales is a good thing, it's increasing my owner's equity. I have to also put it as a positive. Okay, and you can see here my asset is a positive, my owner's equity plus liability is also a positive, because my owner's equity is a positive but my liabilities is not applicable here, so I'll put 0 there. Okay, now we're not done yet. We have to now record cost of sales. How much did it cost us to sell this? Well, they already put account debited there as cost of sales. What is cost of sales? Cost of sales is an expense, and you know already by now expenses are debited. As you can see here in our acronym, we debit expenses. And you know, if you are debiting expenses, of course, our owner's equity is going down. So we're going to put a minus under owner's equity. So let me just do that already. Minus under owner's equity. But what do I credit? Well, the question is, what am I selling? I'm selling trading stock. And if I'm selling my trading stock is an asset, okay, which would debit our assets. However, since I'm giving the trading stock to my client who has just bought the goods, my trading stock is reducing, it's going down. So I need to put it on the opposite side, which is the credit side. Okay, so let's put our trading stock there. All right, that is it for that one. Now, since trading stock is an asset and my asset is going down, I'm going to put it as a negative under assets. You can see asset is negative, owner's equity and liabilities is also negative. So we are still good. Okay, it's still making sense. 1.2.4, the owner took trading stock at the cost of 850 Rand for personal use. Now already, if someone has taken trading stock or I've sold it, if it's left my premises, I know I have to credit my trading stock, and you can see it's already credited here. Okay, trading stock credit. And then what do we debit? We debit what is called drawings. Whenever the owner takes anything from the business for his personal use, and they will always give you those words, personal use or the owner took something, you know that drawings is involved. What is drawings? Drawings is whenever the owner has taken something from the business. It could be cash, it could be a vehicle, it could be equipment, it could be trading stock, whatever he has taken, you know that you have to debit drawings. So I'm going to put here drawings. Now, drawings is an equity account. It reduces your equity. Okay, it's negative, just like expenses. And why am I debiting drawings? Well, look at my acronym here. Debit drawings. You can see here drawings is debited, and so that's why I'm putting it on the debit side. Okay, and then obviously trading stock is credited because trading stock is leaving my premises, and we've put it at 850 Rand. Why at 850 Rand? Why didn't I add the markup of 50% and then get the selling price? Well, because I'm not selling. The owner is taking it for his personal use. We as the business have to just ask ourselves, how much did we buy it for? Well, we're told the cost price was 850, so we have to record it at 850. I hope it's making sense. And so since my trading stock is an asset and it's going down, I'm going to put it as a negative under assets. And since my drawings is an owner's equity account and it's reducing my owner's equity, by the way, then I have to put owner's equity as a negative, and my liabilities is not affected there. Last one, the owner of the business returned damaged goods to the supplier. They were discounted by 5%. The original cost price was 1,800 Rand. Okay, so what is happening here? We return goods back to the supplier. Remember, when we buy goods from the supplier, what do we debit? We debit trading stock and we credit bank. We debit trading stock because trading stock is an asset and it's coming in. That's why we are debiting it. And then we are crediting our bank if we bought it on cash. Okay, we're crediting our bank. If we bought it on credit, we will credit our creditors control, because now we are owing our supplier. And so now that we are returning damaged goods back to the supplier, that means we no longer owe this supplier. And you can see here trading stock is already given to us as a credit. Okay, because we're returning it, it's leaving our premises. That's why we're crediting trading stock as an asset. Assets, when it decreases, we put it on the credit side, as I've been mentioning. Okay, but they gave us a 5% discount. Okay, so firstly, let me put here on the debit creditors control. Okay, creditors control, because we know creditors control is a liability, and when liabilities is going down, meaning we no longer owe our supplier for this trading stock that we are returning, because we are returning it to him, then we have to debit the liability. Remember, the liabilities are credited, as you can see here, but whenever we are paying our creditor, we have to debit it, or whenever we are returning something back to our creditor, we have to put it on the debit side. And since we are returning the goods back to them, we're telling them, hey, we no longer owe you, so we are removing it from our books. We're putting it on the debit side. And what is the amount? Well, we're told that the original cost price was 1,800. Okay, that's the original cost price. But since they gave us a 5% discount, I have to factor that in here. So what am I going to do? I'm going to take the original price of 1,800 and then I remove the 5%. Okay, so I'm going to take 100% minus 5% is 95%. So I just want to record the 95%. Okay, and I will have my amount there, 1,710. That means I was actually charged 1,710 because they gave me the discount. Okay, so that is how much I have to reduce my creditors control by as well. So what is happening here? Trading stock is an asset and it's going down because we are returning it back to the supplier. So that is why we are crediting our trading stock, or it was credited as we're given the answer there. So we have to put our asset as a negative owner's equity is not affected here because this is just creditors controlled and trading stock, so I have to put it as a 0 there. But my liabilities is now affected here because creditors control is reducing. I no longer owe the person that I initially owed, which is a liability. So I'm putting it on the debit side, as I've already mentioned. So I have to put my liability as a negative, okay? Because now I no longer owe them. So I'm reducing my liability. And you can see my assets still equals my equity plus liabilities, because you can see owner's equity is 0, my liability is a negative, and my asset is also a negative, okay? And that is how you do the analysis of transactions, or the accounting equation, and how you do your debits and your credits. I hope you've gained value from this lesson, and if you have learned something, please like this video, share it to those you think it might help, and subscribe to our channel. Till next time, cheers.